Welcome to Master Trader's Weekly Trade Review. I'm Dan Gibby, and in this issue we're going to talk about how to use options to profit during extreme fear or news events that create opportunities in the charts. In these particular examples, most of them are going to be to sell high-priced options. This is our technical approach to trading anything that moves. We start with a compelling setup. No setup, no action, end of story. If we do have a compelling setup, okay, where is it in the overall trend, support and resistance, multiple time frames, showing relative strength or weakness? And we believe in technical analysis, obviously, because it represents the sum total of all market participants. It will show undue fear, undue greed. It will show turning points, it'll show trends, it'll show where buyers are, it'll show where sellers are. So that's why we don't get hung up on the news. We use the news to bring us to a chart to look for tradable events. In these examples, I'm going to show you recently how FedEx had a nasty gap down on earnings and global recession fears, and we had a compelling setup called a climactic buy setup where we sell out of the money puts under support. You can either do it naked. When you sell a put, that means you're receiving the premium and you have an obligation to buy the underlying stock on or before expiration. One contract represents 100 shares, and that's if the put buyer wants you to buy the stock from him. They're only going to do that if the stock falls and expires in the money. As technicians, though, we are using our technical approach to say, well, I don't think it's going under that short strike, and we take that money. We prefer what's called a bull put debit spread, where we sell that one put out of the money, we take some of that money, buy a further out of the money put, and that the net credit is our potential maximum gain that's deposited right into our brokerage account. And then this way it's less buying power requirement at the brokerage firm, and it's less max loss against us if the thing does keep cratering for some reason. So here's what started off the problem recently in the sector. FedEx came out, and it was a week before their earnings. They said they gave a horrible profit warning. They said, danger, danger. Their CEO says he thinks we're headed for a global recession. And so here, where the stock's in a downtrend, potential retest for a small little bounce in a downtrend. Here's our 2050 200. And then this thing just got walloped. You can calculate the percent gap down here. And so as contrarians, we're saying, okay, let's see what the stock does. But when something is gapping down this far from the 20, fear is hitting the markets, that spikes these put premiums. So we're thinking we want to sell these expensive premiums, not blindly, of course, when we see stabilization. So let's follow the trade here. So we gave this is our Telegram alerts. We send these to our subscribers. We shorted the September 23, which was one week away, the $140 puts for $110 share. Why did we do this? Excessive gap on increasing volume, far out of the money, high premium trade on major support. So if you would look at it further on the daily or the weekly chart, 160 was great support. And notice here we gave this at 10:20 a.m. after we had intraday stabilization. And I grabbed these a little bit late, these quotes obviously, because we sold them at $1.10. And here's my position right here, the 140. So we already have an unrealized gain of like 25% of max value already. Close it at 45 cents. Let's just take the money ahead of FOMC. It was actually the day after 3 days actually. I see the dates here. 9/16, 3 days later, I said close at 45 cents a share. So we don't have to hold ahead of the FOMC, which was that day, and also earnings were coming that week. Look at the crazy volume on this thing. So we had a $650 profit on a 10 lot on that. And so the approach that we do is we see if we have a chart, Then we pull up the option table, make sure they're liquid. That's a big problem so many times. You got to make sure these things are liquid. And then we say, using the chart, how far out of the money can we go to get paid? And the reason I say paid is because we're assuming risk. We're taking risk by selling puts because we're agreeing to buy stock at that strike price. So I want to get paid. I call that the juice. I call this the juice bar. What are you going to pay me, Mr. Juice Man? And we got $1.10 in this particular example. And then does the chart support that for the days to expiration? So that's a quick summary of our approach to selling options. And so when we're trading news, I immediately look at the other major competitors. I want to see, I ask myself, who else in the industry is either going to be hurt or helped by this news, and I'm looking for other opportunity. So obviously FedEx, UPS are the number 1 and 2, and this is what we call a gap and snap. Here's my daily chart. Notice these multiple levels of support. So this one gapped here. Look at all this other support from the bottom in May when this thing was a long bottoming pattern. And let's see what we did here. I posted this one pre-market. I said, so over the 30-minute high, so what that means is pre-market, I don't know what this thing's going to do at the open. So we sit 30 minutes. If it can trade over the day's high at 10 a.m. Eastern, then put on this trade. We're going to sell the 167 put, buy the 160 put. That's a bull put credit spread, and for a limit of 65 cents a share. Potential gap and snap with a large gap to major support. Stop, none. We'll roll it if needed. And we ended up taking our money on that trade. But look at this volume. That's when we put on the trade. It's, see the tail here, so it put in an intraday bottom, and that's when we put this trade on. And the volume it within 30 minutes dwarfed all these other prior months of volume. So that's a lot of scared people out there. This is one claim I love saying myself, obviously, and our subscribers. This is a subscriber of ours. I made money and the stock still went against me. That's because when we sell these out of the money puts, as long as it expires above the short strike, worthless at expiration, we keep the money. So the distance from where we put it on to the short strike, the stock can fall that much against me. Here, I put it here on the side here for you. So the stock can fall here all the way down here in 7 days to expiration, and I still make the money. Actually, I take that back. This one, we did a 0 DTE. I stand corrected. This was a Friday, and so we were able to sell these Fridays right here. 2 more examples. This obviously is not a UPS or FedEx, but they're truckers. So the trucking industry obviously is tied to shippers. It's just in a truck instead of an airplane, so they're going to move with it. And we saw the same type of patterns here. This one gapping a little bit beyond the 200 pure moving average, but to this gap fill support. Look at these multiple levels of major support. Here's my juice bar. They didn't have weeklies, so we had to go out 35 days if you want to trade. If you want this strategy, there's no way around it. So we sold these $90 puts. The stock was trading at, call it 103 and change. 90 is way the heck down here. And we sold those for 70 cents a share. And I said, add it $1 if it happens to fall. And then technical setup and so forth. One more example in the trucker industry, XPO Logistics. Just a big gap, far from the 20, all this major support. Look at this, the stock's at 46 and change. We sold at 37.5. I did the math for you. That's 19% lower. And we sold these for 35 cents a share. Put the initial stop based on some further out of the money weekly support, 39.40, and then just manage in between. And we're getting paid 3 ways. One is as the stock moves up, the out of the monies get further out of the money, and it makes these puts cheaper. Number 2 is time decay, and number 3, volatility contraction. So when you're in the middle of fear and sell-offs, volatility rises. So even if the stock just goes sideways in a coma, we are making huge premiums in volatility contraction. One more example, this was last week, Carnival Cruise Line came out, disappointed with their earnings, and look at this, lost a fifth of their value on Friday. And that's just, so it was in a sideways range. Look at the flat 20, flat 50. This is what we call a bear 180 reversal, and then it gapped under 3 levels of major support. It was a gap down on the weekly chart also. There's no support to the left. So this is actually an opportunity not only to sell the out-of-the-money bear call credit spread, which is the opposite of selling a bull put credit spread under support. Our strategies work identical, opposite on all time frames. But this was a bearish pro gap down that we could have bought bearish option strategies. So we buy puts, we buy put spreads, diagonals, etc. We teach them in the course. Obviously, I'm going to be looking at the competitors to see if there's any opportunity in those, similar to like we did on UPS on the FedEx news. And you can see there was just breakdowns across the board. The other competitors are Royal Caribbean, NCLH, which is this one, and then Cook, CUK is CCL's foreign company of CCL, so they trade fairly similar. But that also could have been a directional option trade and bear call credit spread. If you'd like to learn how to trade these strategies and sell credit spreads around compelling patterns, go to mastertrader.com/spread trader. We have a beautiful 5-module course here. We have a very detailed 12-module comprehensive course, which includes one module solely dedicated to selling options on news and high volatility situations like this. And then course here, directional option strategies. And we love trading options over stocks, provided they're liquid, because we have the benefit of leverage and limited risk. Hope you enjoyed that. As always, email my partner Greg Capper or me anytime, and look forward to seeing you in the next trade review video. Good trading all.